Matt and Bryn. Bryn first. So where are we now as we finish a newly volatile week in the markets?
I think what's happened this week has been very healthy for the market. I think the market is saying to the oracles of the world, hey, if you're going to go negative free cash flow and you're going to saddle yourself to a private company that may have decent revenues, but it's still early days, we're going to penalize you. And I think this is very good for the other companies that are like spending like crazy, that there's only so much we're going to allow you to spend. Otherwise, we're going to penalize your stock. So I'm hoping like level heads will prevail, that we won't have these like daily conversations with Jensen, Sam Altman, Lisa Su announcing crazy big deals, and they can keep their head down, do the work, and there can be some type of sanity in the market as it relates to the spend that these companies are doing relative to their balance sheet.
Matt, how do you see it?
I agree with a lot of what Bryn was saying there. Since the April lows, the Nasdaq's up more than 50%, and it's been somewhat of an uninterrupted advance. That can increase the risk profile, especially when it's been momentum led like it's translated into over the summer with non-profitable companies, more speculative types of investments kind of really leading the charge. And really, if you look under the surface of kind of the price action this week, that's where the major damage was done, kind of taking out a lot of that froth. And I think, again, that's a healthy sign that investors are starting to make sure that they're looking at not just the upside opportunities, but also some of the risks that are present in some of this speculative behavior that we've seen manifest over the last few months.
Mike, what makes people especially nervous, and Bryn really hit on it, is that it's not just Oracle. There are so many other companies. It's a whole trade in some respects that is leveraged to OpenAI. And any stumble by that company anywhere along the way has not just ripple effects, but what could be waves turning into something even larger potentially.
For sure. And what OpenAI has obviously done is just try to knit up this web of partners and try to lay claim on scarce resources in terms of data center and processing and capital in a way that tries to secure a head start and an advantage for OpenAI, as you would do if you're competing, with others. But what that also means is, and what the market is kind of registering and punishing Meta shares and punishing Oracle shares, is there's just not going to be enough to go around. It's not going to be winners across the board. So what does that mean down the road? And I really do think the JP Morgan report this week that said, whatever it was, you need $650 billion in revenues to start coming back to justify this level of spending over whatever number of years. That's what got in people's heads. And that's also, though, assuming that all the investments need payoff. All of them are not going to get paid off. So I don't think that means we're at a critical moment, that all of a sudden the credit markets are going to seize up or they're going to start to deprive these companies of capital. But we are going to be always with this debate. We're never going to escape the moment where it's like carefree again and everybody is going to be getting credit for being a winner.
A week in which, too, we got, from B of A, Michael Hartnett saying short hyperscaler debt was one of his best ideas. So it just gets people talking and it makes a market more volatile. Bryn, so taking all of that into consideration, what does it do for us over the final, let's call it 6 weeks of the year?
I think we're going to be bouncing around a little bit more than we thought we would, because obviously the government shutdown, the data that we're going to get around the economy is going to be late and stale if we get it. I do think we had really strong earnings, so that's definitely a ballast that for the market. And so I think it's going to be like, what's going to happen with inflation? I will say that, 55% of components in CPI are growing above 3%. And so I don't know if this December rate cut, which has already come down, is going to happen. So I think we're going to bounce around here. But this a little bit air out of the balloon to me has been very positive longer term, setting up for 2026.
Yeah, Matt, do you think that, people should take advantage of the volatility, the pullback in the market? It seemed like it was hard to find bears out there. And this week, if nothing else, just maybe rekindled some of the negatives that are lurking out there.
Yeah, that's a really good point. There hasn't been a whole lot of kind of bearish activity prevalent in markets the last few months. But, in the background, there still is, the labor market that has been softening. And while we haven't got a lot of good, clean government data, obviously the last month and a half, there has been some survey numbers that, aren't necessarily built bullish by any means. If you look at University of Michigan's survey that, asks respondents, they expect higher unemployment rate. Just hit the highest level since 1980. If that corresponds to a jump in the unemployment rate, that is something that's not necessarily bullish. But at the same time, we're dealing with a situation where we're in a situation where we have back-to-back really strong earnings seasons where we might finish Q3 with mid-teens earnings growth. That by any means is a really strong reporting season across the board, and so it's a balanced picture. And I think the message that you take away from that is just continue to embrace diversification, emphasize quality and security selection. Probably stay away a little bit from some of the non-profitable areas of the market that have been really kind of bid up over the summer times and really starting to correct in recent weeks.